We have officially crossed into the territory of the impossible. For the past 48 hours, we have been dissecting the warning signs of the market. We examined the plunge to $86. We examined the locked doors of the United States Mint. We examined the $13 premium in Shanghai. These were all signals. They were the smoke trails telling us that a blaze was burning somewhere deep within the financial system. But today, Saturday, January 17th, 2026, whispers are spreading that imply the blaze is far larger than anyone believed. We are examining a highly controversial unconfirmed ledger that has gone viral across institutional trading desks this morning. This document claims to reveal the shadow short positions of the largest banks on the planet, positions that are buried inside the over-the-counter derivatives market and never appear on official government disclosures. And the figures on this page are not merely bad, they are fatal. According to these leaked projections, two of the largest banks in the United States, Bank of America and Citi, may be holding a combined net liability of as much as 4.4 billion ounces of silver. Let me repeat that figure because it is so enormous it sounds almost imaginary. 4.4 billion ounces. Now, we must proceed carefully. The official commitment of traders report shows a short position near 500 million ounces. That alone is massive. But if this leak is accurate, if the banks have concealed another 4 billion ounces in off-balance sheet derivatives, then the mathematics of the silver market are fundamentally shattered. To grasp why this would be a death sentence for these institutions, you must understand the physical reality of the silver market. The entire global mining industry, every mine in Mexico, Peru, China, Russia, and Australia combined, produces roughly 800 million ounces of silver per year. That is the absolute ceiling. We cannot print more, we cannot extract it faster. So do the arithmetic. If global production is 800 million ounces and these banks have allegedly sold 4.4 billion ounces, they have effectively sold 512 years of total global supply. They have sold silver that has not yet been mined. They have sold silver that will not be pulled from the ground until the year 2031. This is the textbook definition of a naked short. They have sold a promise they cannot physically fulfill. In a normal market, a short seller borrows an asset, sells it, and hopes to repurchase it cheaper. But to do that, the asset must exist. You have to be able to locate it. Where are Bank of America and Krupp supposed to find 4 billion ounces of silver? They cannot find it at the COMEX. The registered inventory has fallen to 120 million ounces. They cannot find it at the US Mint. The Mint has halted sales. They cannot find it in London. The vaults are empty. Whether the number is 500 million or 4 billion, they are trapped inside a mathematical prison of their own creation. This explains the violence we witnessed on Thursday. Remember the flash crash? Remember how the price collapsed from $92 to $86 in minutes? The media told you that was profit-taking. The media told you it was a technical correction. They were likely lying. That crash looks exactly like a desperate survival-level attempt to manage a liability spiraling out of control. Every time silver rises by $1, a short position of 4 billion ounces loses 4 billion when silver moved from $50 to $90. If these rumors are accurate, they lost roughly $160 billion in paper value. This is why they crushed the price. They were not trying to earn money. They were trying to stop the hemorrhaging. They were trying to prevent a margin call that would liquidate the bank. But here's the problem with a naked short of this magnitude. It creates a black hole in the market. Because they have sold 5 times more silver than exists in annual supply, they have created future demand that is 5 times larger than future supply. Eventually, they must close these positions. They must buy back the contracts. Who will they buy them from? Will they buy them from you? Will they buy them from Samsung? Will they buy them from the Chinese government? Nobody is selling. This is why the price rebounded so quickly. The market understands that short interest, whether official or hidden, is simply future buying pressure. Every short position is a guaranteed future buyer. Bank of America is not a seller of silver. They are a guaranteed buyer of silver. They just have not purchased it yet. This realization flips the entire narrative upside down. We are not looking at a market that is overbought. We are observing a market that is oversold to a degree never seen in financial history. If the shadow leverage is real, we are looking at a short interest relative to annual production of 550%. Compare this to the Volkswagen squeeze of 2008. In that squeeze, short interest was about 12% of the float, and the price surged 500% in a day. Compare it to the GameStop squeeze. Short interest was 140%, and the price climbed 1,000%. We are facing a potential short interest that dwarfs anything we have ever witnessed. The potential energy stored in this trade is nuclear, and this brings us to counterparty risk. If you hold a paper contract for silver on the COMEX, who is on the other side of that trade? Who promised to deliver that silver to you? It is likely one of these massive banks. If they owe billions of ounces and only have access to perhaps 50 million ounces in their vaults, they are insolvent. They cannot deliver. This means millions of people holding paper silver are holding a contract with a bankrupt entity. They are holding a promise from someone who cannot pay. This is why the physical price is decoupling. The physical market suspects the paper market is a fraud. When dealers charge $120 for a coin, they are pricing in the risk that the banks will fail. They are pricing in the reality that paper contracts are worthless because the metal does not exist. We have spent years discussing manipulation. We discussed spoofing. We discussed capping. But this leaked data changes the conversation. This is not just manipulation. This is recklessness on a scale that threatens the stability of the entire global financial system. These banks have allegedly bet the house against silver, and silver is winning. In the next part of this deep dive, we will calculate the insolvency number. We will take the current price of $90, multiply it by this rumored short position, and reveal the hole in their balance sheet. We will compare that figure to the total equity of these banks. And we will show you why the Federal Reserve will have no choice but to intervene. But they will not intervene by finding more silver. They will intervene by printing more dollars. The math is terminal, the liability is absolute, and the clock is ticking. We have established the premise, based on leaked data circulating on institutional desks, that Bank of America and Krupp may be holding a combined shadow short position of 4.4 billion ounces of silver. Now we must perform the math that mainstream media is too afraid to perform. We must calculate the mark-to-market damage. We must quantify the hole in the hull of the ship. Take the current price of silver, call it $90 an ounce to keep the math simple, multiply $90 by 4.4 billion ounces. The result is 396 billion. Let that number sink in. 396 billion, this is not a trading loss. This is not a bad quarter. This is a solvency event. To put this number into perspective, examine the market capitalization of these banks. Market cap is the total value of every share of stock the bank has issued. It represents what the market believes the entire company is worth. Krupp has a market cap of roughly 120 billion. Bank of America has a market cap of roughly 260 billion. Add them together, and their combined equity value is roughly $380 billion. The liability from the silver short position, $396 billion, exceeds the total value of the banks themselves. If forced to cover this position at $90 today, they would be wiped out. Their equity would be zero. Their shareholders would be erased. The banks would technically be bankrupt. And that assumes they could cover at $90. But as discussed earlier, if they attempted to buy 4 billion ounces, the price would not remain at $90. It would explode to $500, so the liability is not $390 billion. It is theoretically infinite. This insolvency equation is the key to understanding the insane volatility witnessed on Thursday. When silver hit $92, the risk desk algorithms began flashing red. The liability crossed the threshold of the bank's Tier 1 capital reserves. They faced an immediate margin call from the clearinghouse. They had two options. Option A, concede defeat, buy back the shorts, send the price to the moon, and declare bankruptcy. Option B, sell everything they owned, paper contracts, gold equities to smash silver back down to $86. They chose option B by smashing the price from $92 to $86. They reduced the price by $6 per ounce. $604.4 billion ounces equals $26.4 billion. In minutes, they reduced their paper liability by $26 billion. That was enough to satisfy the margin clerk for one more day. That was enough to keep the lights on for one more night. This was not trading. This was survival mode. They were not trying to profit. They were trying to avoid immediate liquidation. But here is the catch. This strategy only works if the price stays suppressed. But the price did not stay down. It surged back to $90. The $26 billion of relief evaporated as quickly as it appeared. They are right back where they started, with one major difference. They have expended their ammunition. They have exhausted their ability to shock the market. And while they fight the paper war on screens, the physical market is sending a signal confirming they are already dead. That signal is backwardation. In a normal market for a non-P perishable commodity like silver, futures prices should exceed spot prices. This is contango. It costs money to store silver, insure it, and secure it. So silver delivered in 6 months should cost more than silver delivered today. But right now, the market is in backwardation. The spot price is higher than the futures price. And critically, lease rates are exploding. A lease rate is the cost to borrow physical silver. If you are a bank in short, you can try to lease silver to deliver and kick the can forward. When lease rates go vertical, as they are now, it means there is no silver available to borrow. The owners of silver are saying, "No, I will not lend it to you. I want it in my vault." This is the physical market screaming shortage. When you combine a 4 billion ounce paper short with a physical market in backwardation, you get a death spiral. Banks need to borrow silver to cover shorts, but they cannot because lease rates are too high. So they must buy it. but they cannot because the price is too high and they are insolvent. So they try to smash the price, but the smash fails because physical buyers step in. It is a trap with no escape. This brings us to systemic risk implied by the leak. If Bank of America and Krupp are insolvent because of silver, this is not just a silver issue. It is a global financial crisis. These banks are global systemically important banks, GSIBs. They are the plumbing of the world economy. If they fail, derivatives freeze, credit freezes, ATMs stop functioning. This is why the Federal Reserve and U.S. Treasury are involved. They know about the short position. They have seen the ledger. Why do you think Treasury Secretary Besant called an emergency G7 meeting? Why do you think the U.S. Mint suspended sales? They are attempting to manage the collapse of the short without destroying the dollar. They are trying to engineer a soft landing for a 4 billion ounce bomb. But there is no soft landing for a naked short during a commodity shortage. There is only a hard landing. The only way to save the banks is bailout. The Federal Reserve will have to print $390 billion, and likely far more. They will monetize the silver short. This means silver's price is not rising only due to supply and demand. It is rising because it is being repriced in a currency about to be diluted to save the banking system. We are witnessing the setup for the greatest transfer of wealth in human history. Wealth is transferring from banks who sold paper to individuals who bought physical silver. The insolvency equation is solved. The result is 0 for banks and infinity for metal. But history shows events like this do not occur in isolation. They occur in cycles. They follow a rhythm repeating for over a century. There is a chart, a pattern that predicted this exact moment. It predicted that 2026 would be the year of commodity boom and stock market bust. In the next part of this deep dive, we will examine the BENNER cycle. We will show a chart drawn over 100 years ago pointing to this specific year as the turning point. We will explain why the trap the banks fell into was predictable, cyclical, and inevitable. The banks are fighting math, they are fighting physics, and now history. The $390 billion bill has come due, and they cannot pay. We have analyzed the impossible math of the 4.4 billion ounce short. We have dissected the insolvency equation threatening to erase equity of the world's largest banks. But to truly understand why this is happening now, why the system is breaking in January 2026 and not earlier or later, we must look beyond balance sheets. We must examine the rhythm of history itself. There is a chart circulating quietly among elite macro investors for decades. It is not produced by Goldman Sachs. It is not generated by artificial intelligence. It is hand-drawn from 1875, created by an Ohio farmer named Samuel Benner. Benner observed that market panics, commodity booms, and crashes followed a repeatable pattern. He mapped it on paper over 150 years ago. He called it the BENNER cycle. For a century and a half, it predicted nearly every major financial turning point with terrifying accuracy. And this brings us back to the snare. Why did the banks construct such an enormous naked short position? Were they foolish? No, they were arrogant. They believed they were the market. They believed that because they could issue unlimited paper contracts, they could overpower the laws of supply and demand. They believed they could overpower the cycles of history. This is the arrogance that always comes before the collapse. In 2008, the banks believed housing prices could never fall nationwide. They built a derivatives empire on that false belief. And when the cycle shifted, they were erased. In 2026, they believed silver could never break 100. They built a 4 billion ounce short position on that belief. And now that the cycle has turned, they are being erased again. But this time, the rescue will be harder. In 2008, they only needed to print money to plug the hole. This time, they need physical metal to plug the hole, and you cannot print silver. The BENNER cycle chart is a warning from history. It tells us that these periods of high prices and selling stocks are followed by years of hardship. Hardship for whom? Hardship for holders of paper. Hardship for people who trusted banks. Hardship for people who stayed in equities too long. But for those who hold real assets, silver, gold, land, these are not hard times. These are moments of wealth transfer. The banks are fighting to keep the good times of the paper market alive for one more month, one more week, one more day. That is why they smashed the price to $86. They are trying to delay the inevitable turning of the calendar, but time only moves forward. The year is 2026. The cycle has arrived. The great rotation from paper to metal is underway. The leaked ledger discussed in part 1 shows the size of their wager. The BENNER cycle shows the futility of that wager. They have bet 4.4 billion ounces of silver that history is wrong. I would not take that bet. This historical context matters because it shows the volatility we see, the violent swings, the desperate smashes are not chaos. It is the sound of a paradigm shift. It is the sound of tectonic plates in the financial world grinding together as pressure builds. The banks are on the wrong plate. They are on the plate that is sinking. You, the silver holder, are on the rising plate. And this brings us to the end game of this crisis. If banks are insolvent, the cycle has turned and physical metal is gone. What comes next? How does a bank exit a trade when it owes metal it cannot buy and cannot borrow? There is only one escape. It is a legal clause buried deep in the fine print of futures contracts. It is a clause most investors have never read and never expected to be used. It is called force majeure, or in plain terms, cash settlement. In the final part of this deep dive, we will explore the force majeure scenario. We will explain exactly what happens when Bank of America and Krupp declare they cannot deliver silver. We will examine the wholesale freeze already beginning. Dealers are quoting 6-week delays. Refiners are rationing output. The system is preparing to default. And when default happens, the screen price, whether $90 or $100, becomes irrelevant. The price becomes infinity because you cannot buy it. The BENNER cycle predicted the turning point. The leaked ledger identified the victim, and force majeure will deliver the final blow. We are watching the death of the paper derivative market in real time. Welcome to the commodity supercycle. We have reached the conclusion. If you stayed with me through this entire forensic analysis, you now understand the terrifying scale of the trap banks built for themselves. You understand the impossible math of the 4.4 billion ounce short. You understand the insolvency equation threatening to erase Western banking equity. And you understand the BENNER prophecy that predicted this moment over 150 years ago. The evidence is overwhelming. This is not theory. It is mathematical certainty. We are not witnessing a trading correction. We are not witnessing a normal cycle. We are witnessing the end of the paper derivative market as we know it. So how does it end? How do banks escape a $390 billion liability without metal to cover it? They do not buy the metal. They do not deliver the metal. They invoke force majeure. This is the legal term whispered in commodity backrooms for weeks. It is French, meaning superior force. In contract law, it is the escape hatch. It allows a party to break a contract without penalty if fulfillment is prevented by events beyond control. Typically, force majeure applies to acts of God, hurricanes, earthquakes, wars. But in coming days or weeks, bullion banks will attempt to apply it to unprecedented conditions they themselves created. They will claim Shanghai squeezes, retail hoarding, and supply disruptions made delivery impossible. And they will activate cash settlement. Every futures contract on the COMEX has fine print. That fine print allows cash settlement if delivery fails. This is the nightmare for paper holders. Imagine buying a futures contract at $30. Price rises to $90. You think you almost started one. You stand for delivery because you want silver. Instead of a 5,000 ounce bar, the bank sends a check for the dollar difference. They say, here's your profit. Contract closed. You might think you succeeded, but you missed the point. You wanted silver, not dollars. When you take that check to a dealer, street price is $150. You were settled at a fake price while the real asset escaped. This is already happening wholesale. Industrial buyers report unavailable quotes or 6-week delays. When a wholesaler says 6 weeks, they hope metal appears. It is a soft default, but when force majeure hits headlines, it becomes hard default. It marks official separation of markets. We discussed paper and physical separation before. Under force majeure, it becomes permanent. The COMEX price becomes a museum relic, a zombie number on a screen nobody trades. Meanwhile, the street price explodes. Our analysis suggests when the first major short declares force majeure, street price gaps from $90 to $150 overnight. Why $150? Because panic becomes absolute. That is when Samsung and Tesla realize paper is broken and bid directly for remaining supply. This is the supercycle Samuel Benner predicted. A supercycle is not just a bull market. It is a phase where commodities become primary collateral. It is a phase where those holding metal make the rules. The banks fight this because they trade paper. When paper fails, they fail, but they cannot stop it. The Benner cycle turns regardless of Federal Reserve wishes. Insolvency math must balance. So what is the verdict for you, the individual investor? You stand at the edge of the greatest wealth transfer ever. To participate, follow one rule. Do not accept cash settlement. If you own physical silver, you already won. You exited the system. You hold what banks owe but cannot deliver. Do not sell it to them. They are shaking the tree one last time. This week's volatility, the $86 crash, the $92 rip, is designed to make you drop it. They need your metal to survive. Selling at $90 bails out Bank of America. It bails out Krupp. You hand them the life raft, hold your position. Real silver price is not on a screen. The screen is fiction run by algorithms nearing shutdown. Real price is set by scarcity. How valuable is a missile you cannot build, a solar panel you cannot power? Silver is not a trade. It is the backbone of the industrial future, and banks shorted the future. They bet against tomorrow. You invested in it. That is why force majeure is inevitable. They promise delivery of the future after selling it in the past. When the announcement comes, next week or next month, do not panic. Ignore anchors claiming the market is frozen. The freeze is confirmation. Paper is finished. Price discovery is moving from New York to Shanghai, from derivatives, desks, to vaults. We are watching illusion die and reality emerge. Bank of America and Croup sit on a $390 billion error. Do not make their mistake yours. Make it your gain. Time is running. Vaults are draining. The cycle is turning. Welcome to Real Money Subscribes.